Here's a business that looks simple from the outside. Put two people in a cage or a ring, sell tickets, sell the broadcast, collect the money. It is not simple. It might be one of the most brutally engineered media businesses on the planet, wearing a pair of gloves as a disguise. Here's a number that should stop you cold. A single pay-per-view night can generate over $150 million in revenue, and the exact same event, with the exact same costs, can also lose millions of dollars. Same arena, same production budget, same fighter guarantees. The only difference is whether people outside that building cared enough to pay for it. Today we're breaking down the real economics of owning a boxing or UFC-style combat sports promotion. Because underneath the violence, this is a business built on monopoly control, media rights, and a profit formula so top-heavy it makes Hollywood look stable. Let's start with the idea that reframes this entire industry. The UFC's core asset was never violence. It's exclusive control over the only road that matters for a fighter who wants to be considered elite. Fighters effectively hand over a huge share of what they generate just for the privilege of being allowed onto that road. Because the contracts, the rankings, and the media exposure that make a fighter's career even possible are all gate-kept by a single organization. There's no meaningful second path to the top. You either compete for a contract inside that one system, or you're essentially invisible to the audience that matters. This is exactly why rival promotions trying to compete at that same tier either go bankrupt or eventually get absorbed. They can build a cage, sign fighters, and rent an arena, but they can't replicate the one thing that actually matters, being the road, not a road. That's not a sports business model. That's a monopoly business model wearing shorts and gloves. Here's the number that explains almost everything strange about this industry's profitability. How much of total revenue actually goes to the fighters. In the UFC, fighters typically receive only around 16 to 20% of total event revenue. In elite boxing, by contrast, top fighters can capture 40 to 50% or more of the entire purse pool. That gap isn't a minor accounting detail. It's the structural reason one of these businesses can be valued in the billions with relatively modest fighter pay, while the other concentrates almost all of its money in a handful of superstar camps. Think about what this means for who actually gets rich in each version of this business. In one model, the organization itself captures the overwhelming majority of the value being created. In the other, a small number of individual athletes capture nearly half of it directly. Same sport, wildly different economics, depending purely on how the pie gets sliced. Here's the volatility that makes this business genuinely nerve-wracking to own. Big events have generated somewhere in the range of $155 to $180 million in total revenue, pay-per-view, gate receipts, sponsorships, media, all from a single card. But that exact same model can produce enormous losses if the card underperforms. The promotion still owes arena deposits, production costs, and fighter guarantees regardless of how many people actually bought the broadcast or filled the seats. If pay-per-view buys and ticket sales fall short of expectations, none of those fixed obligations disappear. They're due either way. This is the ruthless equation underneath the entire business. Revenue is extremely superstar dependent, while costs are largely fixed per event. One transcendent star can single-handedly make an entire year profitable. One weak card, with no draw and underwhelming buzz, can sink an entire quarter, even though the production costs were identical to the blockbuster show next door. Here's a fact that surprises people who assume every fight card is a profit center. Most regional boxing and MMA shows lose money, and promoters know it going in. These smaller club shows often run on margins so thin that promoters routinely lose money on events in the $50,000 to $200,000 range. Betting, essentially, that a few of the fighters on that undercard will eventually break out and become the stars who justify much bigger, more profitable events down the line. Most fighters on these cards never reach the level where their name alone can move pay-per-view buys or ticket sales. This means the promotion's entire expected value calculation isn't built around any single small show being profitable. It's built around the probability of finding and developing a tiny number of eventual superstars, using dozens of smaller, money-losing shows as the search mechanism to find them. Here's a cost structure that's completely invisible to anyone watching from the crowd: regulatory compliance. Every single event requires payments to state or provincial athletic commissions, plus licensing fees, surety bonds, medical staff, drug testing, and independent inspectors. These aren't optional line items a promoter can skip to save money, miss a regulatory requirement, and the event can be cancelled outright. The promotion's license can be suspended, or its insurance can be voided entirely. For a new promoter without an established relationship with these commissions, these compliance costs alone can easily run into the tens of thousands of dollars per show, and that's before a single dollar of fighter pay has even been calculated. The fight itself is the visible product. The regulatory machinery keeping it legal is the invisible cost holding the entire thing together. Here's a shift that's completely rewritten how this industry actually makes money. Modern combat sports promotions no longer live off ticket sales at the gate. Media rights, pay-per-view, and streaming deals now form the true core of the economics. Large boxing bouts have generated over $65 million from pay-per-view alone, with total event income exceeding $80 million once every revenue stream is combined. For the top tier of this industry, the physical arena isn't really the product being sold anymore. It's the set, a visually compelling backdrop designed to make the broadcast look and feel enormous, while the actual money is being generated by millions of individual living room transactions happening nowhere near the building itself. This is a genuinely important mental shift. If you're evaluating this business, you're not primarily evaluating a live events company. You're evaluating a global media distribution company that happens to stage its content inside an arena, with the crowd essentially functioning as a visual prop for the cameras. Here's the fragility hiding underneath boxing's biggest triumphs. In elite boxing specifically, a small number of genuine, super fights generate wildly outsized revenue. Two of the biggest bouts in the sport's history each did roughly $600 million, with one fighter reportedly earning over $250 million from a single night's work. But here's the problem sitting just below that peak. Outside of these rare, once-in-a-career matchups, many boxing promoters struggle to find consistent profitability at all. The business is so dependent on manufacturing genuinely rare, culturally massive events that the gap between historic superfight and ordinary undercard is enormous, and there's no reliable way to manufacture a superfight on a predictable schedule. This is exactly why boxing's biggest nights can look like the richest events in all of sports, while the sport's overall financial health, outside those isolated peaks, tells a much less glamorous story. Here's the strategic difference that explains why one promotion can be worth roughly $10 billion, even though its single biggest nights usually generate less revenue than boxing's absolute peak events: frequency. The UFC runs dozens of events every single year, creating a steady, predictable stream of content for broadcasters, sponsors, and subscribers. Any individual card might not hit boxing's absolute highest peaks, but the sheer volume and brand consistency makes the overall business dramatically more predictable than an industry that depends on rare, lightning-in-a-bottle super fights. This is a classic trade-off between two completely different business models sharing the same sport. Boxing bets on rare, massive peaks. The UFC bets on constant, reliable volume. One is built like a jackpot. The other is built like a subscription service that happens to have knockouts in it. Here's a structural decision that quietly protects this entire industry's margins. Most MMA and boxing promotions classify their athletes as independent contractors, not employees. This single classification avoids payroll taxes, employee benefits, and standard labor protections, while still allowing the promotion to tightly control fighters' schedules, sponsorship arrangements, and image rights through contract terms. It also means fighters are generally responsible for covering their own training, medical costs, and management fees, which functions as a massive, largely invisible subsidy flowing directly into the promotion's margins. This isn't a minor legal technicality. It's one of the foundational reasons this business can be as profitable as it is at the top, while so many of the athletes actually generating the content operate with a level of financial precarity that would surprise most fans watching from home. Here's why so much of what looks like matchmaking in this industry is actually something closer to brand engineering. Promoters know that a single recognizable name can generate millions in incremental pay-per-view buys, sponsorship value, and ticket revenue, while an equally expensive event without that same star power can barely break even. This is exactly why so much of the real skill in this business isn't about pairing evenly matched athletes. It's about storytelling and persona building, turning an individual fighter into a genuine brand that people are willing to pay specifically to watch, independent of how competitive the actual matchup on paper might be. The fight itself is the product being delivered. But the star's story is very often the actual product being sold in the weeks leading up to it. Here's a quiet but powerful lever most fans never think about: sponsorship control. In the UFC, fighters are generally required to wear promotion-approved gear, which limits their ability to negotiate significant outside sponsorships and concentrates brand value inside the promotion itself, rather than with individual athletes. In boxing, by contrast, top fighters often negotiate their own sponsors and wear custom trunks and robes, capturing a much larger share of direct brand income for themselves. For an owner evaluating which model to build, controlling sponsorship isn't a minor styling decision. It's a quiet, structural way to centralize revenue inside the organization itself, while simultaneously weakening any individual fighter's ability to build independent earning power outside the promotion's own ecosystem. Here's a genuinely fast-moving shift reshaping this entire industry's geography. Combat sports are expanding rapidly in India, Pakistan, Eastern Europe, and across Asia, with double-digit growth in digital subscribers and pay-per-view adoption in these regions. One striking example: a Ukrainian heavyweight boxer earned more than $75 million combined across 2 fights against a single opponent, a level of earning power once thought essentially impossible for a non-American heavyweight fighter. This kind of outcome would have been almost unimaginable in this industry a generation ago. For anyone evaluating ownership economics today, this global expansion represents genuinely new revenue pools to tap into, but it also introduces new geopolitical exposure and currency risk that a purely domestic promotion never had to think about. The audience is globalizing faster than the regulatory and financial infrastructure built to support it. By now, the real pattern underneath this entire industry should be coming into focus. The world's biggest MMA and boxing organizations aren't primarily fighting businesses. They're media companies. Their most valuable assets are long-term television and streaming contracts, deep archival libraries full of historic footage and highlights, massive social media audiences built around individual personalities, and powerful global trademark value attached to the promotion's own brand name. The fights themselves are simply the content that continuously feeds that much larger media machine. This is exactly the same pattern we've seen across other industries on this channel. The visible, exciting part of the business is almost never the actual asset driving its long-term value. Here, the cage and the ring are the stage. The media rights sitting behind the curtain are the real business. Here's why acquisitions in this industry get priced the way they do. When ownership of a major promotion changes hands at valuations in the range of $4 to $10 billion or more, buyers aren't simply paying for the organization's current profits. They're paying for category dominance, exclusive long-term fighter contracts, and overwhelming media leverage that would be almost impossible for a new competitor to replicate. Any rival trying to build a genuine competitor at that scale wouldn't just need to spend billions of dollars. They'd also need to convince fighters, broadcasters, and regulators to abandon an entrenched ecosystem that's had years, sometimes decades, to build trust and infrastructure. History suggests that's close to impossible to pull off. The price tag isn't a valuation of this year's revenue. It's a valuation of how hard it would be for anyone else to ever build this same road again from scratch. Here's a live experiment currently reshaping part of this industry. New ventures are explicitly trying to bring UFC-style cost control into boxing, targeting fighter pay around just 15 to 20% of revenue, instead of boxing's historical norm of roughly 50%. If this approach succeeds, it could meaningfully compress purses at the top of boxing, while making the overall business dramatically more investable and scalable for outside capital, effectively trying to turn boxing into a more promoter-friendly version of itself, closer to the UFC's structural playbook than to boxing's traditional star-driven purse model. Whether this actually works long-term is still an open question. Boxing's culture and existing star system are deeply entrenched. But it's a clear signal that sophisticated capital sees the UFC's fighter pay structure specifically as the more attractive, more scalable business model to replicate, rather than the other way around. Here's the operational reality that separates a hobbyist promoter from a durable billion-dollar organization. Running a single show is a genuinely manageable challenge. Running 15, 20 or more shows a year, with consistent quality, safety, and profitability across every single one, is an entirely different kind of business. That requires deep, trust-based relationships with athletic commissions, venues, and broadcasters built up over years. It requires a genuine pipeline of developing talent and real matchmaking expertise to keep audiences engaged between rare superstar-level events. And it requires a brand strong enough to sell pay-per-view buys and subscriptions even during stretches without a constant parade of transcendent stars on the card. Most promotions that fail in this industry don't fail because of a bad vision or a bad initial idea. They fail because they can never solve the much harder problem of executing consistently, profitably, at real scale, month after month, year after year. Here's the final risk layer, and it's the one that doesn't show up in any financial model until it's far too late: reputational and legal risk. Beyond the direct dollar costs we've already covered, a promoter carries genuine legal liability for fighter safety, medical protocols, and contract disputes. A single high-profile injury, or worse, a death inside the cage or ring, or a major lawsuit, can scare off broadcasters and sponsors overnight, trigger serious regulatory investigations, and permanently damage brand trust that took years to build. That intangible risk is every bit as real a cost of ownership as fighter pay or arena rental. It simply never appears as a clean, predictable line item on a profit and loss statement, right up until the moment it becomes the only line item anyone is talking about. So let's go back to where we started. A $150 million night, or a multi-million-dollar loss. Same arena, same production budget, same fighter guarantees. The only real variable was whether the story around that card was compelling enough for the world to pay attention. That's the whole industry, compressed into one idea. This was never really a fighting business. It's a media and monopoly control business, wearing gloves as a costume, where the real assets are exclusive contracts, broadcast rights, brand trust, and control over the only road that matters to the athletes trying to walk it. The cage is the stage. The contracts, the media rights, and the story being sold around each fighter are the actual business underneath it. And once again, exactly like every industry we've broken down on this channel, the flashy, visible part is almost never where the real risk or the real reward actually lives. If this changed how you watch the next big fight card, subscribe, because we're just getting started pulling apart the businesses hiding behind the headlines. See you in the next one.